comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm. Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Hey there, folks. Welcome to another episode of State Tax Talks with Joe Tantillo. Today, we'll be discussing the final part of our three-part series on sales and use tax issues for contractors. I'm joined once again by Josh Lawrence and Joe Endres from Hodgson Russ, and we're going to dive right back in, and we'll be talking about audit issues faced by contractors, as well as some fun war stories that these guys are going to share.
The reason we are so busy in this space is because the tax department conducts audits of these businesses at a significant pace. I mean, if you're a contractor, there is a good chance that at some point, you are going to get audited because the tax department focuses on this industry because they know that the rules are so complicated that it's tough to get them right. And, they're probably a little more jaded. They probably think that there's a lot of underreporting going on if you ask them. But the rules are, in fact, complicated in this space. So it's just tough to comply with. Auditors know they can often find liability in a contractor audit.
Well, let's talk about the audits. I want to discuss kind of what the audit process is and preparing yourself for an audit as well. Because I have very basic questions, like you guys were talking about, just the example of purchasing a bunch of panes of glass. Maybe some of it's going to go into capital improvement, and some of it's just going to be used to repair some broken windows. Like, how do you keep track of all that? And are companies really keeping track of all that? And should they be? Because that feels like an area on audit that you're going to just dive into every single purchase and ask, what was this for? What was this for? What was this for? And probably most of those materials, right, are going to be divided amongst several things. So I'm rambling, but
No, that's a great question. And that is the heart, the heart of the matter when it comes to these things, record keeping, because each job essentially requires its own record keeping structure. And when you're doing a lot of high volume of work, that's tough to deal with, but that is the answer. You do need to be able to have a system in place to be able to distinguish where your materials and how your materials are used. And to the extent that you don't, you're opening up yourself to some risk that an auditor is going to decide that for you. And I don't know about your experience, Josh, but anytime you give an auditor the discretion to come up with a way to determine something, it always results in tax.
Yes,
so,
yes.
It's a big risk.
But yeah, for a contractor, an audit, the process is essentially the same. Like any sales tax vendor, they're going to audit the sales, right. They're going to audit the recurring purchases, and they're going to audit the fixed assets. And on sales, for a simple contractor that constructs buildings, that issue usually isn't a problem, especially if the contractor has basically just taken a capital improvement certificate on each job. Then that's just a matter of sending all of those, providing the sales journal to the auditor, but then backing that up with exempt organization certificates or capital improvement certificates.
And just real quick on that point on the certificates, just keep in mind that it's not the certificate that makes the transaction exempt. The law either taxes or exempts the transaction, not the certificate. Mm-hmm. The certificate is just the document that can be used in order to make the audit easier, right? To shift the burden, to give coverage to the contractor or to the party involved. But if you don't have these certificates, the tax department has to give you the opportunity to prove that the transaction was what you're claiming it was, whether it's a job for an exempt entity or a capital improvement or whatever it was. Just because you don't have a certificate doesn't make the transaction taxable. You can still prove that fact after the fact, essentially. It's a lot more work. So you really don't want to be in that position unless you have to.
And I don't know if we mentioned it. We talked about getting the certificate from the party that you're working with, but like, who ultimately issues the certificate? Do you have to apply to the state to get the certificate issued, or can just the end party who's hiring you to do a capital improvement go online and download a certificate and sign it and give it to you?
Mostly that. If we're talking about a capital improvement certificate, it's an ST-124. It's available online, and you just have the customer fill it out and give it to you if you're the contractor. Same thing with the ST 120.1, the one that the contractor exempt purchase certificate. It's a blank form on the tax department's website. The contractor just fills it out and gives it to the vendor that's selling them the exempt material. But it's a little more complicated with exempt entities, right, Josh? The exempt entity has to apply to be an exempt entity for purposes of sales tax. And then once they have been approved as an exempt entity, there is nothing they can download. An exempt entity can't download it. So they will be issued an exempt entity, exempt purchase certificates, 119.1, I think.
Right.
And so there you do need the government involved. So more often than not, you can just download the form, but every now and then, especially if you're dealing with exempt entities, they need to do stuff ahead of time to be able to.
Right. And so I think not on the exempt entity point, but back to your point about like the certificate is not what actually exempts it. It's the law. You could theoretically just have a contractor taking a very liberal position on whether something was a capital improvement and issuing these certificates to all of their subcontractors. And then because maybe it's the subcontractors getting audited, right? And, do you have a lot of detrimental reliance?
So that brings up an interesting point. So it is the property owner who is certifying to the contractor that the work constitutes a capital improvement, which raises kind of a question: who knows better whether the work qualifies or not? And there's actually case law on this that basically says, look, if a contractor has accepted a capital improvement certificate, it's generally protected, even if the work on audit is found not to have been a capital improvement, because we treat exemption certificates the same as long as they're accepted in good faith. It could be a resale certificate or another type of. If you accept that in good faith, you're generally protected. But the question becomes, since the contractor is generally in a better position to know whether the work qualifies or not, can they accept a certificate on something like a partial roof repair? And the answer is pretty much no. If a contractor accepts a capital improvement certificate on, let's say, a complete remodel of an existing apartment or something, and some of the work doesn't qualify and some of it does, generally that certificate will be honored. An auditor might try to nitpick and say, you shouldn't have accepted it with respect to this. But that really becomes more of a problem for the property owner in that case, because the exemption certificate is supposed to shift the burden of proving the non-taxability of the sale to the other party.
And I presume the contractor in that circumstance could go to the property owner and then collect any necessary tax.
At that point, if you're the contractor, you're saying, no, I don't have to. This was an exempt job and I have an exemption certificate. Go to the property owner to collect that tax if you think they haven't properly issued the certificate.
Got it.
The position we take. And again, keep in mind, a proper certificate needs three things. It's got to be fully completed. Mm-hmm. That means every box that needs to be checked or filled out has to be checked or filled out. Anything that is left blank invalidates the certificate.
Right.
It has to be timely received. Generally speaking, I think it's 90 or 120.
Days.
90 days. Okay, 90 days with it from the transaction. And lastly, as Josh mentioned, it's got to be accepted in good faith, which basically means you have no actual knowledge that it's being misused. So once you have those three things, you're covered by the exemption certificate.
So in general, the sales aspect of an audit for a contractor can be pretty simple if it's pretty simple construction work and they have all the certificates in place. The problems a lot of the times arise in the purchases and the audit of the purchases, because a contractor may have done some work for non-taxable entities, may have done some work outside of New York State, may have done some work where they've installed production machinery, and it becomes a question of, well, what should they have paid tax on and what shouldn't they have paid tax on? And just because they issued an exemption certificate to their supplier or subcontractor doesn't relieve them from the inquiry. It may relieve the subcontractor or supplier from any further inquiry. But the problem that I find in audits on the use tax issue, the purchases, is that a lot of contractors don't have a good job costing system where they can say, here is every purchase that we made for this job, and this job was for an exempt entity, and therefore every invoice that you look at for this job is non-taxable. A lot of contractors don't have that. It's just because it becomes a jumble, and they're looking at invoices, and on some of them they paid tax, and on some of them they didn't, and there's no way to prove that this purchase went to that job. And in the absence of those records, auditors will just default to taxable and make you prove it. And if you can't prove it, it becomes an issue. And I find that the liability in audits for contractors is typically on the use tax side.
Oh yeah, absolutely, 100%. And by the way, I mean, we haven't even scratched the surface on some of the crazy rules governing contractor purchases. Like, we haven't gotten into heavy equipment and whether or not there's an operator. Are you buying a crane or are you buying a crane with a service operator? So what you're buying is a service, because one's taxable and one's not. and so there's all these crazy rules, even within the purchase side of the audit, that contractors still need to know. It's like the limo, right? Are you buying a limo, or are you buying a limo with a driver and a certain non-taxable service?
My mind went, we're going to buy the crane with the driver, and the driver is going to live in the crane, and we can use him whenever we want.
I mean, we have a client that rents cranes in multiple states, and it wants to make things simple by just saying, yes, we provide an operator with the crane, but everything else suggests that we're renting you this crane and you have total dominion and control, and our driver is just at your beck and call. And that causes problems for them, because a lot of states say, no, that's a service. You should have paid tax on the crane, and you're using the crane in our state, so you've got to remit use tax on the crane. And we said, no, we bought it for resale, and every transaction is just a rental.
That's the problem, is that with sales tax, you're always, whatever position you take on the sale end can impact the taxability of the purchase end.
Right.
So that's the problem, is, are you thinking about the sales tax audit properly so as to really reduce the liability as much as possible?
It seems like this general topic too of contractors, there's a lot more nuance than there is even, and there's already a ton of nuance in sales tax.
Yep.
So, gentlemen, any other audit considerations that we should discuss before we move on to our final thoughts for the episode?
Yeah, so one area on audit that often creates disagreements is the fact that most auditors don't want to look at every piece of paper, and most taxpayers don't want auditors to look at every piece of paper, every transaction that occurred during the audit period, which is usually 2 or 3 years, if not longer, if not 6 years, if you're not filing returns. So what happens is that both parties typically agree to look at a test period. In other words, we're going to look at a quarter during the broader audit period, and we're going to see where you got your tax right and where you got your tax wrong. And if there is any liability there, we're going to project it to the entire rest of the audit period. So we look at 3 months or 6 months, and then we project it to the 3 or 6 years. That's the idea behind it. The problem with it, or not the problem, but what you have to be careful of, is the fact that how you do that projection really matters. What numbers you use, what methodology you use can have a drastic impact on how big the liability is. Change one number in a multiplication, that's going back 3 or 6 years, can have a huge difference in the projection. So that is an area that you have to, and that's true for all sales tax audits, not just contractors, but where it becomes particularly difficult for contractors is because they need to have such good record keeping, especially what material is used in what job, that it can have a huge impact there in particular.
Joe, you said it, the projection issue and the use of extrapolation and test periods can be a big factor in audits, and that's usually the way that they're done with contractors, and so nothing to add there.
Well, I'm sure there's more we could talk about with respect to audits, but I figure, as we're moving into kind of the final phase of this episode, you guys have done a lot of these audits and a lot of assistance, and you've got to have some great stories. So I figured I'd give an opportunity if there are any interesting stories or unique stories that came as a part of, an audit of a contractor or litigation related to a contractor. This is the time to share.
Well, I'll never forget, and this was one we worked on together. We got involved really kind of, I'd say, in the first quarter of the audit, right? So we didn't start the audit. It had been going on for a little bit, but didn't get too far into it. And the auditors at that point had issued an initial statement of proposed audit change, and it was something like $5 million to this business. And that's in tax, like $5 million of tax. And that kind of goes to, why are these audits so prevalent? Well, I mentioned they're prevalent because, maybe the tax department thinks there's a lot of underreporting, or because they're so complicated, there's always liability. But the other reason they're so prevalent is because we're talking about big dollars here. Right. You're building a building, right? These are hugely just massive projects, very expensive projects. So the tax on these projects, if you get it wrong, is also massive. This is big dollars. And so we got involved in this transaction, or this audit of this contractor. It started off with a $5 million tax assessment with interest and penalties. It was close to $10 million. And we just kept working, going back. The audit itself took like 2 years. So this is not a slow process. I mean, having to dig in, and if we have to go back and prove exemption certificates and getting all the proof there. And so it was basically a 2-year audit. But by the end of the audit, I think we got it down to something like $50,000 because we just kept going back with all these different issues, all these different transactions. So I guess my point here is if you're starting off with an audit and you're hit with this massive bill, I mean, that's something to take seriously and be very concerned with. But because these rules are so hair trigger, you can get that big bill reduced dramatically if you know the rules and if you can work on them to get to a better result.
Yeah, and the story I'll share is my favorite audit because it was we won on a matter of law, which is always satisfying when you're at an audit with contractors. It's all facts and purchases and stuff like that. But we had a pool company that supplied pool contractors, pool builders, pool maintenance people, all kinds of people that worked on pools with all their supplies, and for a huge region of New York. And they had thousands of customers. And they basically had this practice where they just gave a resale certificate to every, most of their customers and just said, hey, fill this out and we won't charge you tax. But there's a rule that says, contractors can't really, whether you're a contractor doing like maintenance of real property or building buildings, you're not supposed to be able to use a resale certificate. You have to pay tax up front. And so they audited this company's sales and there was millions of dollars of liability in sales, but they had an exemption certificate for every sale. And the question became, did they accept these certificates in good faith or not? And we were able to show the law in New York says that, it's a pretty liberal standard, at least for resale certificates, that even though generally a contractor can't use one, just because the person that presented it may have had the word contractor in their name or was they could tell by going on the website that they built pools. We were able to establish that they accepted these in good faith because there's no duty to really question or police all of your 1,000 customers. And, some of these companies built pools, but they also had like a showroom where they would sell a couple supplies to you. And so we got them out of that liability. Unfortunately, what happened next is we started getting new clients, which were the pool contractors. And those audits didn't go so well.
Right.
So that sort of gives a little recap of the importance of exemption certificates and the shift of burden of proof and sort of how this stuff plays out in the real world. That's my favorite capital improvement contractor story.
Well, I think that's an excellent story to end the episode on. Gentlemen, thank you both for joining today. This was a great conversation. I think we only just scratched the surface of these issues as they relate to contractors. But who knows, maybe somebody listening out there right now will, be signing up for a Joe Andrus or a Josh Lawrence presentation on this topic. They're happening all the time, especially in November when Joe's on his crazy stretch run of the presentation circuit. But guys, thanks again. Folks, if you're listening out there, this has been another episode of State Tax Talks. I am Joe Tantillo. We'll see you next time. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.